We thought it would be very worthwhile, given the extreme market turmoil and concerns about tariffs, that we give you a little more of an inside scoop into some of the conversations that the investment team have on a daily basis. So I decided to sit down with Bob Sewell, one of my colleagues. Both of us are key members of the investment team and decision makers on our strategy. Probably no surprise, the topic that we picked is around tariffs and the implications for markets and economies, and that all leads into what should you be doing as investors, if anything.
The sense right now is tariffs aren't going away. This has been a long-standing view of the administration, right? And so, and Trump in particular. So it seems to me we have to kind of get used to an environment where the U.S. is more isolationist in its perspective. Its economy is more insular. So a move away from globalization and I think what would bring some comfort to the markets and the economy as a whole is just certainty or greater clarity, right? If we can get to a place where economies or countries know what to expect in the sense of the amount of tariff that they're going to be paying going forward, then things can be done to adjust for that. The good thing in this environment is how we're positioned, right? I mean, we are global in our entire investment strategy, and fixed income and equities, private and public, and it's that diversification that's frankly the best positioning you can take when you have higher uncertainty in the marketplace and in the global economy.
And I always try and tell clients it's how you're positioned before these unexpected events happen that matters, and that's why we spend so much time thinking about the portfolio construction, the combination of having both public and private market securities that will behave very differently when we come across these events.
Yep, you're absolutely right. It's more about what we've done versus what we're doing today in preparation for, again, what we anticipated to be a more volatile period, albeit certainly more volatile than we were expecting, for sure.
Yeah.
The interesting aspect of that, though, is both economies have been incredibly resilient over the last number of years to economic shock. Right, we've had wars and we've had a lot of other events occur that may have led us to recession, but both economies have remained resilient. So that's I think a bigger factor today for us in our decision making and in our asset allocation decisions. But
yeah, it's maybe a good segue into what exactly does it mean for Canada. I think to some degree Canada's been spared at least this first round of reciprocal tariffs, but they obviously still have the significant tariffs on the auto sector, at least for today. Mm-hmm. They've got large tariffs on steel and aluminum, and these are major industries for Canada that may start to hurt our economy right away. But obviously there's going to be a period of negotiation, and it feels like there was an unofficial agreement perhaps between Carney and Trump that they would allow the Canadian election to go forth, get a new prime minister selected, and then they would start renegotiating perhaps a new Canada-Mexico-U.S. trade agreement, which is really up for renewal in 2026, but they'll probably get going on that right away, I would think.
Yeah. I think it's hard to see an outcome, though, where Canada isn't hurt by this, right? It's got to force Canada to make some changes in its economic approach, and it's got to start to move in a direction where, we are truly looking at a global trading strategy, and how do we get our oil and gas to market at world prices, and how do we trade more with other economies, even with, the U.S. remaining, obviously a very significant trading partner long term.
Yeah, it's certainly unified and galvanized Canadians. So this is really a great time to look at long-term opportunity within Canada. For whatever reason, we have these intra-provincial trade barriers, which probably make not a lot of sense. Those can get knocked down hopefully fairly quickly. most of the resources that the U.S. wants, Canada has,
Right.
and we can do a better job of using them as a country ourselves. And I think this was also a wake-up call that we just perhaps became too dependent on the U.S. And again, the new government is going to be looking for ways to increase trade agreements with other countries so that businesses can have a new opportunity set of customers, new suppliers. So this, I mean, it's going to take time, but hopefully this is something that Canada comes out stronger in.
Right. So I think the next question you have to be asking is, how will companies respond to this environment?
Yeah, I think every business right now is just really hungry for some clarity. They need to know the rules of the game before they make new decisions and long-term investments. But I think ultimately, given that we think that there'll be some aspect of a tariff there for the long run, they're going to have to decide whether they pass that additional cost on to their customers in the form of higher prices. And if they do that, they obviously run the risk that they might choke off demand to some degree. Or they can decide that that extra tariff cost actually lowers the profitability for their business. And ultimately, it's going to be a tough decision, and I think each industry is going to handle it a little bit differently.
Yeah, I think that's a good point. The academic research, though, says that at least historically, about 90% of those tariffs get passed through to the end consumer. And I just say, I think it'll vary by industry and their pricing power, but if history's any indication of how this will play out for companies, then you would have to anticipate that the vast majority of those costs will flow through to the consumer, which obviously is a negative impact and again would contribute to higher inflation moving forward. But there is some portion that typically does get absorbed by companies, and so some margin impact would be likely as well.
Yeah, and that's probably also going to weigh a little bit on any sort of significant capital expenditures that they may make over time. Obviously, President Trump wants production brought back to the U.S., but you have to remember that many of these companies have spent hundreds of millions of dollars setting up facilities in other countries, and there were a lot of reasons why they did that. So not only is Trump asking them to walk away to some degree from those investments, but then put more hundreds of millions of dollars into new production facilities in the U.S., all the way along having potentially less profitability on their business or a threatening of less demand because they've raised prices.
Right. Yeah, they're hard decisions for these companies to make at this point.
There's really two things that our investment team are weighing right now is what's a company's potential direct exposure to the tariff hit, but secondly, what would be the indirect exposure if the tariffs do translate into an economic downturn or recession? And again, that's why having a well-diversified portfolio where we've got some exposure to more defensive industries that if we did go into an economic recession, they would hold up much better than perhaps more of the cyclical-oriented industries.
Right. Hopefully our clients know that, we're on top of this, right? We're managing their portfolios, we think, in a very prudent manner, that our strategy is well suited for periods of higher volatility. So that part is, I think, well at hand.
Yeah, it's interesting. I mean, this is never a fun period for anyone as an investor, no matter how long you've been investing, but it's unfortunately a fact of life. If you're going to be a long-term investor, you're going to go through periods like this. But at the same time, these type of temporary market setbacks, call it, are not going to disrupt your long-term plan. As long as you have a good structure and discipline in place. So you really want to make sure that you're sticking with that plan. One of the things that our advisors work closely with our clients on are any potential income needs or liquidity needs that they may have coming up over the next year or two. And it's just really important, and especially important in these type of environments, to try and give your advisors as much warning so that we can, if needed, restructure the portfolio to make sure that it's well protected to meet those needs.
Yeah, I think that's absolutely the case, and I think really at the end of the day, we've had a number of good years of really solid returns in client portfolios. So yes, this is a setback, but again, focus on the long term, stay the course is really the answer.
Yeah, I mean, it would have been great if we kept getting 20% years from the S&P 500, but that obviously isn't realistic.
Right.
Now we're just giving up a little bit of those returns over the last 2 years, but everybody's still well ahead of where they were a couple of years ago.
Right.
We hope that you find this more casual conversation between Bob and I useful, and hopefully it'll give you some insight and confidence into the type of discussions that are being had behind the scenes to ensure that your portfolio is being managed in the most prudent and proactive manner.